Financial accounting and reporting. A global perspective. Financial accounting and reporting, a global perspective / 4th edition, chapter 1, accounting, language of business. Learning objectives. After studying this chapter, you will understand 1. That accounting is a language that helps model, describe and understand business activity. 2. What accounting, financial accounting and managerial accounting represent. 3. That financial accounting is practice based on a process of recording transactions. 4. That reporting on the financial condition of the firm through financial statements is the end product of this process. 5. That different users with often different objectives are interested in financial accounting information. Thus accounting practice is a compromise between the requirements of each constituency. 6. How basic transactions are recorded and impact financial statements. 7. That there are 3 financial statements: statement of financial position or balance sheet, income statement, and the statement of cash flows. 8. What are the characteristics and roles of each financial statement? 9. That accounting historically is a very old recording tool and decision-making support tool. Accounting is inseparable from business and management. In this book on accounting and reporting, discussing business issues and decisions from the point of view of both management and investors. Accounting is the language of business is a frequently heard expression. Let us see what is behind what has by now become a banal expression.
1. A model of business activity. Business is about action, transformation of resources, and involves transactions between several people. Robinson Crusoe, alone on his island, may have had undertakings, but could not have had a business. Business involves suppliers and customers, but also a variety of people, each bringing to the business a specialized skill set that will be used in the enterprise's transformation process. Business is about transforming one resources into something else, product or service, tangible or intangible, aimed at meeting some customer's expectation. The market offering by the producer is its value proposition, functionalities, availability, durability, selection, location, etc. of the product or service. Creating and delivering the value proposition consumes resources. The customers who choose to acquire a value proposition will hand over some of their resources to its producer. The purpose, and requirement for survival, of business is that the resources acquired from sales exceed the resources consumed in creating the sale, i.e., that it creates profit. Each skill set provided by individuals or groups of individuals, marketing, R&D, and engineering, purchasing, manufacturing, selling, hiring, coordinating, managing, measuring, etc., contributes to the transformation process of resources into making available, and delivering effectively, a product or service value proposition to a solvent customer base. Business decisions involve how resources will be acquired, allocated to each skill set and utilized, i.e., transformed, to serve customers. All decisions in an enterprise are therefore built on a representation of the transformation process that includes a description of the role of each skill set. Each firm has its own vision of its transformation process, and therefore about its allocation of resources it is its specific strategy. The strategy of firms in the same sector, such as global clothing retailers, may be very different in terms of market segments targeted, sourcing, brand policies or stores location. For example, Inditex, of Spain, the world's largest clothing retailer, operates under 10 brand names to serve broad segments of the market. The best known of these brands, Zara, represents only a third of its outlets and caters to the needs of young men and women. Hennes and Mauritz, of Sweden, the second largest global clothing retailer, after Inditex, uses only the one single brand H&M and caters mostly to women. Inditex is largely vertically integrated and controls both the in-house design and manufacturing of its products, only partially outsourced to low-cost countries. Meanwhile, Hennes and Mauritz is much more decentralized and uses over 800 horizontally specialized factories in low-cost countries to produce the garments it designs, often with the help of guest designers. Inditex operates over 5,000 stores in 80 countries, while H&M operates 2,300 stores in 43 countries and thus have different supply chains. These enterprises are the two world leaders in apparel distribution, but, even if they are in the same risk class, their strategies are different and their operations follow different approaches. Yet, accounting must be able to generate documents that allow users to compare their financial performance and their prospects, despite their differences. Accounting must, therefore, be generic enough to be applicable to a variety of situations and business models. A generic representation of the activity of any business is shown in Figure 1.1 as a cash pump cycle. In this cycle, acquired resources are transformed into a value proposition, physically packaged as goods or services delivered to customers. These, in turn, exchange cash, or other resources equivalent to cash, for said goods, and that cash is, in due course, used for the acquisition of additional resources. The cash pump cycle is essentially endless, as long as the enterprise can acquire resources and continues giving satisfaction to enough customers, who perceive this value proposition as being better than that of competitors, and receive more cash from these customers than it must give to all its suppliers, including labor and capital providers, that allow the transformation cycle to continue to take place. Figure 1.1 The generic business model is a cash pump cycle. Flow of cash, arrows pointing left. Flow of resources, goods, or services, arrows pointing right. P.4. This cash cycle needs to be monitored by the managers of the firm. Every transaction between suppliers and the enterprise or between the enterprise and its customers, but also inside the transformation process, whether it is contributing to procurement, manufacturing, or collecting from customers, needs to be recorded in order to serve as a basis for analysis over time. For example, does the enterprise need more or fewer resources than it did during the previous period in order to find a customer or create a new product or service? How does the firm look, on a variety of dimensions, compared to its competitors? Does the enterprise require more resources than its competitors to find a reliable supplier of a resource, or to keep human talent inside the firm? The only way for the various managers and actors in the firm, actors operating the cash pump, to be able to analyze transactions and take any action required to maintain the competitiveness of the firm is to agree on shared rules for describing transactions so decision makers can communicate with one another. In other words, they need to share a language with its vocabulary, grammar, and syntax to describe events and transactions that need to be examined in order to manage the cash pump. That language is called accounting. 2. Accounting, a language for business. Accounting is a specialized language that has the specificity of being able to describe a state or a result, such as, the sales revenue obtained from customers in the month of October amounted to 12 million currency units, CU. Describe the events, purposeful mobilization and consumption of resources, that led to that result, such as, an advertising campaign worth 750,000 CU was run on TV in the first week of October, market share increased by 10% between October 1st and October 31st, on October 1st prices were reduced by 5% from what they had been since last year, additional customers were acquired etc. Provide a possibility of rank ordering results, allowing evaluators of accounting signals to be able to say this result be it for a time period, or for a market, or a responsibility center is better, or worse, than that result. Figure 1.1 must therefore be amended to show that accounting is needed to support decision making. Figure 1.2 illustrates such amendment. Accounting records every event of an economic nature that flows through the cash pump or business cycle. Accounting records economic variables principally using monetary units. It can, however, also describe non-financial parameters as in a physical balance of the weight of materials consumed, which, in a well-managed organization, must be equal to the weight of finished goods plus that of waste. Figure 1.2 accounting describes and is linked to every part of the activity of the firm. The thin solid lines refer to internally generated accounting data and information, while the dotted lines refer to data and information, used in accounting but emanating from either suppliers or customers. P.5. Accounting is an integral part of the life of business. It is as inseparable from business activity as the shadow is to the illuminated object. Accounting helps managers know what was done so they can modify their future actions in order for the future to yield results that will be either as coherent or more coherent with their intent and objective as those of previous periods. The reader will remember that the title of this book is Financial Accounting and Reporting. Why also reporting? 2.1 Business creates an agency relationship that calls for reporting. Business is about delegation. Delegation from the capital providers to the managers in charge of creating wealth with the capital they were awarded, and delegation within the organization to specialized managers, responsible for skill set pools, to work in a coordinated and coherent way to create wealth, among other things for capital providers, but also for other participants in the business process. Delegation means control. Was the devolution and autonomy granted used appropriately? Control requires that information be provided about what the delegate, or agent, i.e., beneficiary of a delegation of right to make decisions, did and what results were achieved. The flow of information, allowing control by the delegator, or principal, is called reporting. Reporting is accounting for what the subordinate, or delegate, has done with the resources she or he has received from her or his superior or principal. A report may document effort or results or both. If effort, on the part of the agent, is reported, accounting will be detailed and will provide the values of those parameters needed to describe the business processes transforming resources into a value proposition and its delivery. Reporting on effort will be strictly internal and business specific. It is called managerial accounting. If, on the contrary, only results are reported, the report may be generic since questions from users of financial information are essentially the same regardless of the nature of the business. This type of report will be the focus of this text and is part of what we call financial accounting. The questions, or informational wants or needs, are essentially about three topics. A. Whether the business has created value for capital providers, current or potential, i.e., a comparatively positive return on investment, given a certain level of risk and will continue to do so at what kind of rate of growth. B. Whether current and past actions increase or decrease the level of risk the firm is facing, and C. Whether the resources the business controls make its operations viable for the future, and for how long, this question being of prime importance for employees, customers, and suppliers, among many stakeholders 3 in the business. 2.1.1 Reporting to capital providers. The cash pump cycle described in Figure 1.1 is not completely operational. Like any pump, this one too must be primed. How can the business acquire resources to feed its transformation process unless there is already some cash in the enterprise before it starts to operate? Suppliers might extend credit to prime the pump, but the operating, transformation, cycle might be much longer than the duration of the credit the suppliers are willing to extend. There must be capital providers who provide initial financial resources that will be used to prime the transformation cycle. The business manager is therefore the agent of the capital provider. She or he has received the mandate to use the capital to earn a positive return within acceptable risk-taking practices. In some cases the entrepreneur/manager and the capital provider might be one and the same person, but, as we will see later, it is essential to distinguish the business activities from those engaged in privately by the individuals who are either providing capital or are the operators of the transformation process. Since the providers of capital are not, in a capitalistic system, doing so without the motive of earning a return on their investment, it is normal for a business to report on what they used the funds for and what output and outcome was obtained from their application to the transformation process, i.e., what wealth was created. There are two kinds of capital providers. Those, known as shareholders in the case of an incorporated business, who, A. are investing capital for an unspecified term, B. are willing to assume or share, directly or vicariously, the risks of the business, in exchange for a variable but hopefully large return, in the form of dividends, but mainly in the form of capital gains when they will sell their shares, and C. are participating in decision-making, directly or through the board of directors representing them. Those, known as lenders, who, A. are not willing to assume much of the risks of the business and, B. want a guaranteed return on their provision of funds within, C. a specified short, medium or long-term horizon. Each category of funds provider has specific needs in terms of reporting, which the accounting information system will need to satisfy. Lenders are mainly interested in being kept informed about the ability of the business to pay interests in a timely fashion and reimburse the money it has borrowed by the due date. The emphasis is therefore on the cash generation potential of the firm. Shareholders, by way of contrast, are interested in two types of information. On the one hand, from a fiduciary point of view, shareholders want to know, periodically, what the firm they have invested in owns or controls, and what their share of ownership is, and be sure that appropriate checks and balances are in place to avoid inappropriate disbursement of resources. We call the accounting report that serves this purpose the statement of financial position or balance sheet. On the other hand, they are interested in knowing how much residual wealth was created in the transformation process that they can claim as theirs. We call the accounting report that serves this purpose the income statement or profit and loss account. In addition, both lenders and capital providers are interested in knowing more about the plans of the business and the dynamics of the evolution of the relevant and specifically defined cash pump. Figure 1.2 can now be enriched again to recognize the complexity of all processes behind the life of an enterprise. Figure 1.3 reflects, in addition to the representation of the business cycle, the cash pump, the fact that an initial flow of capital is essential to start the value creation cycle, transformation process. Long-term funds providers need to be rewarded by either dividends or interest payment, to be provided with information, reporting, about how efficiently the business is functioning, to use that information as a proxy for how the firm is likely to perform in the future, as long as the business model is not changed. Since accounting reflects all economic transactions, it is the key medium of communication inside the firm, as well as with its partners or stakeholders, including capital providers and lenders among the many we list in EndNote 3. Figure 1.3 Flow of funds and flows of information, accounting and reporting, between a business and its funds providers. The solid black lines indicate that accounting information reflects the flow of resources within the business cycle, while the black dotted lines indicate information carried by the accounting system that come from either suppliers or customers. The blue lines show the flow of resources linked to the relations between the business and its funds providers. Funds provided are illustrated by downwards arrows, and upwards arrows reflect payment of interest or dividends. Accounting information is another type of resource that flows between parties. Reporting to funds providers originates from the accounting information system, which is straddling the frontier of the business entity, but also includes additional data that also pertain to the firm's success and its ability to remain a going concern, such as goals, actions, results, etc. P.7. 2.1.2 Reporting to business partners. Although, technically, the firm is not an agent of employees, customers, or suppliers, the firm has not received a mandate from them. It is normal, if the relationships with these actors are to be durable, that they be kept informed, since they are de facto partners in the future success of the firm. All others who need to evaluate the risks of a business and the likelihood of its survival will use, for that purpose, accounting reports that were originally prepared mainly for capital providers. These other users will do so by surmising the business model and looking at telltale ratios or metrics describing the health of the cash pump process, both in terms of efficiency and relevance, but also in terms of security of provision of funds by capital providers. We call this financial statement analysis, and chapters 15 to 18 are devoted entirely to such activity. 2.1.3 Reporting to superiors and peers. Accounting describes transactions linked to and results of actions and decisions. It is normal and convenient, since the information already has been captured to satisfy capital providers, that a superior uses accounting information to verify the subordinate discharged her or his responsibility appropriately. If the superior is only interested in results, information in a format similar to the one used to report to capital providers might prove to be sufficient. Financial accounting is results-oriented, while, if the superior is interested in evaluating the effort of the subordinate, she or he might be interested in the detailed steps undertaken by the subordinate in fulfilling her or his mission. In this case, the accounting report will be more process-oriented and will be called, as already mentioned, managerial accounting. 2.2 Accounting is a living language. As we have seen, accounting provides a description of what actors in the transformation process of the firm do. The process of the cash pump is one of value creation. Business makes sense only if more resources, in the broad sense of the term resources, i.e., financial and non-financial, are created as the outcome of the transformation process than were consumed in its course. The process of doing business changes over time. The application of the generic cash pump changes continuously, in order to adapt to innovations and the evolution of competitive pressures. Business relationships are affected by technology. For example, the introduction of the internet has greatly modified the way the transformation process is organized. Web-based marketplaces and speed of communication change the relationships between enterprises, suppliers, and customers. Similarly, new issues appear with the evolution of society. For example, 75 years ago, few businesses paid significant attention to the possible creation of a retirement income for their former employees. New business issues are born every day that accounting must be able to describe as an enrichment of what was previously provided. The reality that accounting describes is alive and evolving continuously. The accounting language must therefore be very strong and flexible and rest on solid principles that will allow that flexibility. Accounting is a language, and its words are symbols that reflect a certain view of the world. Just like our everyday language evolves continuously, accounting must be able to adapt to the needs of the time. Accounting is a very special language in that the way it describes the world of business affects the timing or recognition and measurement of wealth creation. Just to give a brief example, when one buys a machine, one could offset the purchase cost against the revenue generated by the use of the machine during the first year, a procedure called cash accounting, or one could consider that the machine will be useful to generate sales over several years, and therefore one would offset, in the first year, only a part of the cost of the machine, depreciating the machine over its useful life, a part of what we call accrual accounting. Clearly, the choice between cash and accrual accounting will affect greatly the perceived timing of the wealth created through the use of the machine to serve customers. Accounting is so important for the smooth operation of a society that few countries have allowed its evolution to go unchecked. Language is essential to the operation of any organized society. Cardinal de Richelieu, Prime Minister to the French King Louis XIII, founded in 1635 the Académie Française to create, standardize, and regulate the French language. His decision was both political and economical. It was, of course, part of a process to unify the kingdom. There were over 25 main local languages or dialects spoken in the kingdom, and facilitate its government, but, also, to facilitate inter-regional trade. There is no easy business transaction if the two parties do not speak a relatively common language. In a process similar to the unique case of the French attempt at standardizing their language, accounting standards-setting bodies have been created in many countries to define, regulate, the terms of this special language to facilitate measurement of wealth creation and therefore open exchanges and facilitate the support financial markets provide to the development of businesses. Today, regulation of the accounting language is carried out at the global level because businesses trade globally, and financial markets, as well, span the globe. Thus local regulations tend to be on a path towards convergence. See Chapter 5. p.8. 2.3 Accounting is a language with some maneuvering room. Accounting, because of the variety of requirements placed on its applicability and evolution, remains, by necessity, built on very broad generic principles. This leaves some room for customizing the representations it creates to the specific needs of businesses, or classes of users of accounting information. The accounting language must be able to describe any business activity. It must allow any user to shape their opinion about an economic entity by looking at the entity's financial statements. These statements are the end product of the accounting process. The user's opinions and decision-making are built on several aspects of a business entity's potential, financial situation, through the statement of financial position/balance sheet, sales performance, and efficiency in its consumption of resources for the generation of sales, through the income statement, and cash generation and its uses, through the statement of cash flows. Financial statements allow users to take very concrete decisions such as whether to invest or not in the business entity, to acquire additional resources for the entity, to give, or receive, credit terms for settling accounts between customers, or suppliers, and the business entity, to grant, or seek, or not a loan, to provide the basis for calculation of taxation of business entities by tax authorities, etc. Since there are different, yet perfectly legitimate, 5 ways of describing the same reality, especially the timing of recognition of profit, the choice of an accounting solution, embodiment of principles into practice, will impact the perception financial markets and funds providers hold about a business enterprise. The stakes are high in communicating fairly and effectively the value created and the value creation potential of the business segments a firm manages. Practitioners, managers, and the media have even coined the expression accounting strategy to reflect the fact that there is wiggle room in describing a given reality. An accounting strategy means that, sometimes, when needed, in theory to better serve the users, one can alter the accounting representation to achieve better the purpose of communicating at that time. Clearly that maneuvering space has to be regulated. Although room exists for variations in measurement, timing, and classification of a given reality, over the long run the results are always the same, but the decisions of the users of accounting information may have been affected in the meantime. Some accounting changes are also required by regulation. Some quotes illustrate this point. Chinese online book retailer e-commerce China Dangdang Incorporated's fourth quarter 2010 net profit fell 33% from a year earlier due to an accounting change. Dangdang said net income would have improved without the change. Net profit fell because the company started recognizing promotion fees it receives from suppliers on a quarterly basis in its last fiscal year, rather than once a year. Adapted from Dow Jones International News, March 9, 2011. Source: Fact of a database. This example illustrates the concept of revenue recognition. See Chapter 6. Here the change in accounting method is related to the periodicity of recording of promotion fees received from suppliers. These fees, a common practice in the distribution sector, are usually recorded as a reduction of expenses, cost of sales or cost of revenues, and increased net earnings. Until 2009, the company used to record these fees once a year in the fourth quarter. Starting in 2010, the company recorded the promotion fees along the year, every quarter. Consequently and mechanically, the earnings of the fourth quarter of 2010 are impacted only by the amount of promotional fees corresponding to those recognized in that quarter only and not, unlike in 2009, by the fees received for the entire year 2009. Comparing earnings of the fourth quarter 2010 and the fourth quarter 2009 shows a reduction of earnings due to this change. NTPC Ltd6 topped market expectations with a 38% rise in fourth quarter net profit, as India's largest power producer by capacity benefited from higher sales and a change in accounting rules. The company said that a change in accounting rules helped drag its depreciation cost for the quarter 4.6% lower to INR 6.98 billion, adapted from Dow Jones International News, May 10, 2011. Source: Fact of a database. This example illustrates a change in the depreciation method, a concept, which will be more fully covered in Chapter 7, applied to a tangible asset. According to the 2010-11 annual report of the company, the reduction in the amount of depreciation is due to change in the accounting policy pursuant to the opinion expressed by the Controller and Auditor General of India. In this opinion, power utilities companies should apply new depreciation rates. As the annual report does not provide more information about the new depreciation rates, we can only guess that the depreciation rates have been reduced by the new regulation, due to their likely allowing an increase of the useful life of the power plants. LAN Airlines, the Chilean international air carrier, announced as a preliminary estimate that the impact of the adoption of IFRS 7 will result in a 4.3% decline in the company's shareholders' equity share capital and non-distributed earnings. See Chapters 2 and 11 as of December 31, 2007. This represents a $42 million reduction and as a result adjusted shareholders' equity will amount to $946 million, adapted from Business Wire, September 30, 2008, source: Fact of a database. This example illustrates the impact of the implementation of International Financial Reporting Standards, IFRS, i.e., the change of the whole coding system. The change may be perceived as detrimental to the immediate apparent profitability, but it is mainly a modification in the rules guiding the timing of recognition of expenses and revenues and possibly a change in the rules concerning the recognition of certain elements of the commitments of the firm. Whether switching from one standard of reporting to another or from a whole framework to another, for example from local GAAP, generally accepted accounting principles, to IFRS, the change most of the time has a real impact on the reported income of a firm, or its shareholders' equity, i.e., the book value of their claim on the firm's assets. However, the directionality of the impact cannot be specified ex ante. The apparent paradox that switching to IFRS appears to have a short-term impact which may appear to be either positive or negative to the unprepared user can easily be explained. The set of standards and topics covered in the IFRS is extremely wide. Depending on the topic covered, the impact on companies' accounts can vary widely, depending on the standard that used to be followed and the firm's circumstances. However, in the long run, the impact is generally negligible since it mainly reflects differences in timing of recognition of full effects of transactions. These examples also illustrate that accounting is not just a blind application of mechanical or deterministic rules. This is why the field has drawn so much interest for so long. Within a limited set of rules and principles, the language of accounting is there to serve the users by giving the most useful, true, and fair description of a sometimes ambiguous reality, especially when it comes to the timing of the recognition of expenses and revenues. This chapter defines financial accounting, introduces the various users of financial information and describes some elements of the accounting process. The following section revisits the distinction we briefly touched on in the introduction between reporting issues to shareholders and to third parties, financial accounting, and issues of efficiency in the use of resources, managerial accounting, before presenting the qualitative characteristics of useful financial statements. Accounting is almost as old as human economic activity. We therefore provide a short overview of the history and evolution of accounting over the years. Accounting, being the language of business, is, like art, an open language. An artist can use a variety of techniques to create a representation, a portrait, for example, of the reality of her or his model. However, unlike art, accounting, because it must be universal, will follow a socially accepted set of rules of representation of reality. These rules evolve over time, just like those of painting or sculpture, with technological advances and changes in social and societal values regarding relevance. 3. Definition of financial accounting. 3.1 Accounting. Accounting is about information for decision-making, i.e., more than just data, about the economic and financial aspects of the life of an enterprise. It comprises 3 facets. 1. To count is to measure and quantify. 2. To account for something is to acknowledge its existence and describe it. 3. To be accountable is to explain what one has done with resources one was entrusted with and take responsibility for the consequences. Accounting, by carrying out the first 2 facets, contributes to the third. It is thus an essential part of reporting. Accounting is, of course, a method of counting and measuring. It makes transactions and their consequences real. We cannot discuss what we cannot measure, as Lord Kelvin VIII said. Accounting is a system of acknowledgement of the socially defined parameters describing the economic life of an enterprise, be it for or not for profit. By describing the economic reality of actions and consequences in a firm's life, accounting becomes a tool for accountability and reporting. What is reported is the basis of analyses for decision-making. Broadly speaking, accounting information is an essential decision support tool. Most decisions in a business are about resource planning, resource acquisition, and resource allocation and usage in order to fulfill the firm's strategic intent. See, for example, Libas, 1999, 54. These decisions are based on financial and non-financial, i.e., operational, information. Such information is the output of an ongoing process of identifying, capturing, managing, analyzing, interpreting, and distributing data describing the economic activity of the firm. Accounting has 2 key missions. To facilitate value creation by supporting resource acquisition, allocation, and usage decision-making. Value can be reduced to economic wealth if one refers only to shareholders who are looking for a financial return on their investment. However, we will keep using the term value because it refers to the broader concept of being better off for a variety of stakeholders whose utility preference functions may not be expressed solely in economic or monetary terms. To measure and report to stakeholders the amount of value created during a given period. Although accounting is a complete discipline, this duality of missions has traditionally led to separating it into, though closely interactive, subclasses on the basis of the different users who have access to its output. The first is called managerial accounting. It deals with a rather detailed account of how resources, which may include non-financial resources such as employee or customer loyalty or ability to create a network of resource providers, are acquired, managed, and used in the various business processes constituting the firm and is thus of particular interest to managers inside the firm. The second one is called regulated, legacy or financial accounting. It is the focus of this text. It is aimed at reporting, in a somewhat aggregated way, the economic performance of the firm to essential external users such as shareholders, bankers, creditors, customers, unions, tax authorities, etc. Financial accounting focuses on the financial or monetary aspects of performance. Since its output will be used by outside investors and stakeholders to allocate their own resources, accounting information is a social good and therefore is generally regulated, as mentioned earlier, so that all classes of users receive, in a timely fashion, signals of equivalent significance. As we will see later, such a distinction between the accounting subclasses is somewhat artificial and often causes debates as to where the frontier should be placed between them. 3.2 Financial accounting. Financial accounting is a process of description of the various events that take place in the life of a firm. These events are essentially transactions between the firm and outside partners, suppliers of resources and customers of the firm's output. The description of each elemental transaction is materialized by source documents that contain both financial and non-financial elements to allow evaluation of that transaction. These are recorded, classified and analyzed so as to allow for the periodic creation of synthetic reports called financial statements. These comprise a statement of financial position or balance sheet, an income statement, notes and, in countries following IFRS or US GAAP, i.e., most countries, a statement of cash flows. Financial statements are established periodically. It is traditional to create these synthetic documents at least once every year, generally around a date when sales activity is the slowest, and, logically, inventories are at their lowest. The origin of the annual nature of financial statements can probably be traced back to the cycle of nature as it applies to economic undertakings such as hunting or farming. After the harvest was completed, the farmer calculated the amount of wealth created before it could be distributed between the various stakeholders according to the contracts binding the partners, owner of the land and provider of the labor force that created the harvest, for example, in such formats as sharecropping, shared risks, alas not always in the fairest of ways, farming, the landowner assumes no risk since she or he will receive a fixed rent from the operator of the agricultural business, or salaried labor force. The landowner assumes all the business risks. It was traditional to close the books on the harvest, at the end of the production cycle, i.e., at the end of the year, in the Northern Hemisphere. Therefore many countries have retained a preference for a civil year-end closing. However, in businesses such as retail sales, home electronics, toys, or gift sales and many more, a civil year-end closing would not make much sense as that is a period of boom. It would be more logical to close the books, i.e., prepare the synthetic financial statements, when business is slack, inventories are low and the wealth or value created by the business cycle is pretty well definitively acquired. For example, a toy retailer might logically choose to have a year-end in February or March, rather than at the end of December, as it expects few returns more than 2 months after the year-end boom sales. The topic of the choice of a closing date is developed further in Appendix 1.1. From the above definition of financial accounting, several keywords merit attention. Process. The method of describing events and transactions and collecting the descriptors is organized by what is called the accounting process. It is a set of rules and practices, supported by hardware and dedicated software, and coordinated through the activities of a variety of people, extending well beyond the staff of the accounting department, such as procurement, payroll, inventory managers, materials handling, etc. Transactions include such events as the acquisition of resources, selling the firm's output, securing workspace through the signing of a lease, payment of the monthly rent, obtaining a loan from a financial institution, etc. Financial accounting only recognizes transactions that have or will have monetary implications, i.e., which will result in an exchange of cash at some point. However, rules that govern financial accounting create certain exceptions such as depreciation, in which the cash transaction, acquisition of the fixed assets, takes place before the recognition of the value creation event, recognition of the consumption of the value creation potential of a piece of equipment or an asset, see chapters 2 and 7. Materialization of transactions. Each transaction is materialized by a concrete document, invoice, bank statement, voucher, receipt, secure instructions given by electronic communication, etc. If a transaction is not documented, the accountant cannot recognize it and record it. For example, if a business were to acquire a resource without a corresponding invoice or pay a worker without some supporting auditable document, it would be impossible to record it. Analysis of transactions consists in defining the category or class each transaction belongs to, so they may be aggregated into homogeneous classes. This step in the accounting process, described further in Chapter 3, is often manual, with the possibility of human errors and inconsistencies. This classification and aggregation tends, however, to be replaced or supplemented by automated procedures, for example by the definition of barcodes placed on types of documents corresponding to certain transactions, or by linking software such as the accounting recording and invoicing software so that transactions are automatically recorded in the appropriate category, or by using some form of artificial intelligence to indicate to an operator, on the basis of partial information about the transaction, either a suggested logical class or, on the contrary, indicate incoherence in the selected classification of part of the transaction. Recording is generally carried out on a regular periodic basis, most frequently, daily, and in chronological order. This may explain why the record of these transactions is called the journal, from the root jour, in French, meaning day, see Chapter 3. Valuation consists in attaching to the transaction the monetary amount that will be recorded. It is often easy to know the monetary value of a transaction when it is backed by an invoice, but the choice of the amount is, often, a more subjective decision as, for example, in the case of an exchange of non-cash assets, or in the recording in the acquirer's books of the purchase price of an acquired business that is comprised of both physical assets and such intangible assets as a loyal clientele or a brand name, the monetary value of which depends on what the acquirer will do with it after the acquisition. Financial statements, also called accounts or annual accounts, they provide a synthesis of the performance of the firm in terms of wealth or value creation. The statement of financial position or balance sheet describes the stock of resources of the firm at one point in time and the claims on that stock. The income statement describes how and how much wealth or value was created between two balance sheet dates. Notes to the statements explain choices made by the firm and give more details about some transactions. The statement of cash flows, see Chapter 14, describes the cash situation, and how it changed during the period. Periodicity of financial statements, also called frequency of reporting, has been generally agreed to be at least 1 calendar year, IAS 1, IASB, 2007, 36, but these can be established for any period duration, if it is useful for decision makers. 4 Users of financial accounting. 4.1 Presentation of the various users. Financial accounting reflects the economic activity of the firm. Its purpose is to allow users to understand its situation in comprehensive and synthetic ways. It produces information for managers as well as for third-party stakeholders. Financial accounting is also often used in establishing tax obligations and is therefore subject to regulation and control by tax authorities. Creditors expect from financial accounting that it will help them better understand the profitability of the firm, as well as its ability to generate cash in the future to repay its lenders. Customers, suppliers, and employees alike look to financial accounting for information about the ongoing nature of the business. Their questions bear on whether the firm is a going concern. As we can see, there are many, see, also, Endnote 3, users of financial accounting. Each group has, by definition, different needs and expectations from the others. However, the first user of financial accounting information should be seen as the firm itself. Managers need to have a synthetic view of their collective performance. They are, after all, the ship's captains in the high seas. It is impossible to create a hierarchy of users. Any rank ordering would be context and culture specific. Figure 1.4 illustrates a generic list of potential financial accounting users and is not meant to carry any idea of rank ordering. Figure 1.4 a set of financial accounting users. The diversity of needs of the different users is analyzed in further detail in Table 1.19 that illustrates how each class of users may employ financial statements for their own purposes. Table 1.1 Users and their different needs. Users' types of needs, not an exhaustive list. Accounting source documents, accessible information, accounting and other, delay to obtain information. Management information to plan, make strategic and resource allocation decisions and control transaction documents. Financial statements total access. From source documents to financial statements information is accessible on an ongoing basis. Its availability depends on the organization itself. Shareholders/investors are concerned with the risk inherent in, and return provided by, their investments, and information to help them determine whether they should buy, hold, or sell, and information to assess the ability of the enterprise to pay dividends. Financial statements plus additional publicly available information about the successes of the firm in its markets and in its operations. The date on which the financial statements must be made available before the General Assembly is regulated in each and every country. The trend is towards earlier publication. Bankers, lenders information to determine whether their loans, and the interest attached to them, will be paid when due. Financial statements, both historical and pro forma, i.e., forecasts. Financial statements plus additional publicly and privately available information about the successes of the firm in its markets and in its operations. A business will produce any additional ad hoc documents whenever it needs to raise funds from banks or on the market. Suppliers and other trade creditors information to determine whether amounts owed to them will be paid when due. Trade creditors are likely to be interested in an enterprise over a shorter period than lenders unless they are dependent upon the continuation of the enterprise as a major customer. Information to determine whether the study firm offers better business opportunity in the future and therefore to decide if any preferential treatments should be offered to this particular firm. Financial statements. In theory, these users have no particular claim on financial information beyond the published financial statements, but by benchmarking and comparative analysis plus an organized intelligence watch, they can interpret financial information in a detailed manner case by case. Customers' information about the going concern nature of an enterprise, especially when they have a long-term involvement with, or are dependent on, the enterprise. Customers are especially interested in evaluating the viability of the firm as an ongoing supplier for service after sales and/or for future orders. Financial statements. Just like suppliers, customers will ask information directly and cross-reference it to be able to have leading signals indicating possible opportunities or problems case by case. Competitors to compare relative performance. Financial statements. Competitive analysis will be the output of large databases of financial statements, cross-referenced with business intelligence and a good understanding of the economic sector case by case, as a function of the amount of resources dedicated to information gathering. Employees' information about the stability and profitability of their employers. Information to assess the ability of the enterprise to provide remuneration, retirement benefits, and employment opportunities. Financial statements access is regulated through legislation in every country case by case, moderated by local legislation. Government, regulatory agencies, tax authorities are interested in resource allocation and, therefore, want to know about the activities of enterprises. Also use information in decisions to stimulate the economy, to determine taxation policies and assessments. Also use some or all the information in the calculation of national economic statistics. Financial statements, often recast in a predefined tax-based format, possibly following different rules on a recurring basis. The tax-formatted financial statements plus, in the case of a tax audit, access to all source documents. Each country has specific rules. For example, in the UK, most companies are required to pay income tax no later than 9 months and a day after the end of an accounting period. General public enterprises affect members of the public individually and collectively. For example, enterprises may make a substantial contribution to the local economy in many ways, including the number of people they employ and their patronage of local suppliers. Financial statements may assist the public by providing information about the trends and recent developments in the prosperity of the enterprise and the range of its activities. Financial statements regulated access case by case. While all the information needs of these users cannot conceivably be met by only one set of financial statements, there are needs that are common to all users. The International Accounting Standards Board, IASB, one of the two main accounting regulators in the world and the one whose rulings we follow in this text, explains that many existing and potential investors, lenders, and other creditors cannot require reporting entities to provide information directly to them and must rely on general-purpose financial reports for much of the financial information they need. Consequently, they are the primary users to whom general-purpose financial reports are directed. See Conceptual Framework, IASB, 2010, OB 5.10. Limited liability companies must periodically file financial statements with a regulatory organization such as the Registrar in the UK, the Commercial Register in Spain, or the Commercial Courts in France. Such filings are required in each European Union member country for the protection of third parties. The European Union reinforced such an obligation by the 1st, March 9, 1968, and 4th directives, July 25, 1978. The EU Directive No. 90/605, November 8, 1990, essentially extends to all incorporated businesses, whatever their form of incorporation, the requirement to file financial statements. 4.2 Financial Reporting Standards, how to satisfy the user's needs. The obligation to serve the various, and numerous, users of financial statements, mentioned in the previous section, require that financial information be the result of a unique coding of events and transactions. For that reason, within each country, local regulations issue generally accepted accounting principles, GAAP, 11 that are called accounting standards or financial reporting standards, CN Note 7. Accounting standards are authoritative statements of how particular types of transactions and other events should be recorded and reflected in financial statements. These standards include specific principles, bases, conventions, rules, and practices necessary to capture the data and prepare the financial statements. The concept of financial reporting standards and their evolution on an international basis is developed in Chapter 5. 5 Introduction to the accounting process. An illustration will show how the need for accounting arises from a simple set of transactions between persons or corporations and how the accounting process is created to monitor and record these transactions. Although our example is set at the time of Luca Pacioli in the 15th century, it is so generic and simplified that it communicates the pedagogical message. It is a wink to the fact that modern business, in the 21st century, even if the vocabulary may have changed, is fundamentally not so different from what it was 600 years ago. Let us assume we are at the end of the 15th century in Venice. Costas, a young merchant of Greek origin, wants to become rich and powerful. A quick survey of his environment leads him to the conclusion that the most effective way for him to achieve his objective is to trade with the Orient. His family had endowed him with some 120 gold ducats. In order not to mix his own estate with the risky venture he is considering, Costas, as an individual, creates a separate entity he calls Venture Costas, or VC for short. Costas decides to invest 100 of his ducats in this entity, VC or the venture. Costas, as the sole investor in this business venture, holds claim to all the profit the venture might create in the future. He is a 100% owner or shareholder. However, if profit is to be created, this initial capital of 100 ducats is not enough to buy and commission a ship to start trading with the Orient. Such an activity would require about 1,000 ducats. Thus Costas, now as the manager of the venture, visits a Florentine banker who agrees to lend the venture the 900 additional ducats it needs for the acquisition and outfitting of a ship. The loan will be for not more than 5 years and will carry an annual compound interest rate of 10%, compounded in that, for example, if the loan duration is greater than 1 year, the unpaid interests of the first year due on the principal will themselves bear interest in the future years and so on. The interest is to be paid in one lump sum on the date of the return of the ship or at the end of the 5-year term, when the principal must be reimbursed, whichever comes first. The venture must record that it has entered into 2 obligations. It has agreed to refund the money it received from the banker, the principal of the loan, not later than 5 years from now, and it has agreed to pay a compound interest charge of 10% a year for as many years as the money will be borrowed. In a blank notebook or diary, let us call it a journal, Costas, as manager of VC, records the commitment the venture has made. If VC were to take stock of its wealth at that moment, it would show on one side the cash it holds, the original 100 ducats provided by Costas, the individual, plus the cash received from the banker, and it also would record the debt commitment that, if and when the loan were called by the bank, would diminish the wealth of the venture. Essentially, VC's net situation, value of resources minus debt to others than shareholders, has evolved this way. Situation before the loan from the banker, wealth or net worth equals 100 ducats. Situation after the loan is received from the banker, wealth equals 100 ducats plus 900 ducats received minus a debt of 900 ducats equals 100 ducats. Borrowing, in itself, does not create wealth. It is what the money will be used for that, eventually, creates wealth. The wealth account, statement of financial position or balance sheet, of the venture at this stage is presented in Table 1.2. Table 1.2 VC's wealth account at Step 1. Venture Costas owns Venture Costas owes. Cash in hand, 100 900, 1000 ducats owed to banker 900 ducats. Total 1000 ducats total 900 ducats. Net worth of Venture Costas, conceptually, it is owed by VC to Costas, the individual capitalist, 100 ducats. Accounting alone, i.e., recording, does not create wealth. 12 It only keeps track of what the economic entity, Venture Costas in this example, does with its resources and what claims, so far, only from the lender and from the investor, exist, at any point in time, on the resources of the business. The owners, investors or capitalists, claim is equal, at any moment, to the net worth of the enterprise, i.e., the sum of the resources minus the claims from the lender, s. Since the venture has done nothing so far to create wealth, there has been neither productive transformation activity, nor trading of output with third parties. The claim of Costas, the individual, is still equal to the 100 gold ducats he invested in the business. Costas, as the manager of VC, then uses the cash resource, 1000 ducats, to buy a good ship, outfit it, staff it and load its hold with cargo and merchandise. The captain of the ship will trade in the Orient, actually the Near Orient or Middle East, at the eastern end of the Mediterranean, at the end of the overland Silk Road from China. Venture Costas' wealth has not changed. Cash has simply been changed into tangible goods. If VC were operating in a perfect market with no transaction costs, whether it holds cash or merchandise should not make any difference. Both are resources that VC, as an economic entity, can and will use to try to create future economic benefits, i.e., wealth. The VC wealth account once the expedition is about ready to depart reads like Table 1.3. Table 1.3 Wealth account after Step 2. Venture Costas owns Venture Costas owes. Cash in hand, petty cash, 10 ducats owed to banker 900 ducats. Cash in the hands of the captain for sailors' future wages and operating expenses 150 ducats. Inventory of food and consumable supplies on board 330 ducats. Inventory of merchandise to be traded 350 ducats. Ship and equipment 160 ducats. Total book value of resources 1000 ducats total 900 ducats. Net worth of Venture Costas 100 ducats. Since VC owns goods, a ship, and cash worth 1000 ducats in total, but owes 900 ducats, its net wealth, or net worth, is still only 100 ducats. Not only does Table 1.3 show VC's net worth, it also lists all that the venture owns, structured in different classes or categories of resources. Such a document is of great importance for controlling the efforts of the captain, Venture Costas representative or agent, in his efforts to create more wealth. It can also be used to verify that no pilferage takes place, internal control. At any time, Costas, or someone else, can verify the physical existence of what resources the venture owns. The fact that Costas was able to select a good captain, a good crew and a solid ship is very important. The likelihood of success rests on the quality of the captain and his or her crew. Costas' worth, as an individual, not only represents the reality of what he owns, he is the sole proprietor of VC, but that ownership represents a potential profit to come if and when the ship returns and is sold along with its cargo for more than VC owes the banker. His hope and intention is that the captain of his venture will bring back more than just one ship. He has encouraged him or her to behave as a privateer and capture as many enemy ships and place them under his, her, control. Costas is looking forward to the success of the VC expedition. Costas is expecting it will take 4 years before the ship can be expected to return, hopefully loaded with more valuable merchandise than it sailed out with. Costas needs resources to live on while the venture runs its course. He realizes that not only has he handed over most of his cash to the venture, but, also, he is not even entirely confident in its success. Business is risky. He wants to obtain more cash to live on, as an individual, and hedge his bet, i.e., diversify his risks. He therefore seeks partners who are willing to share the risks and the returns of his planned expedition. He finds a wealthy friend who agrees Costas has bought a solid ship and hired an excellent and entrepreneurial captain who is likely to return with valuable goods. This friend buys, in exchange for 500 ducats in cash paid to Costas, the individual, a half share of the rights and claims Costas, as an individual, holds over the venture, i.e., half of the net worth today, which includes the right to receive 50% of the possible profit realized if and when the ship returns. Essentially Costas, individual, sold privately a state conditional claim, 50% of future profits or losses, whatever they will be, for 500 ducats, thus reducing his own claim on future profits from 100% to 50%. The wealth of the venture remains at 100 ducats, although the wealth of Costas, the individual, has been modified by his receiving 500 ducats in cash. The fundamental advantage of having created venture Costas is that the shares, i.e., unit claims on future profits, can be sold privately by shareholders. Such a sale has no impact on the situation of the venture itself. Costas' claim on the future profit of the venture has been reduced to 50% while it used to be 100% before his private transaction with his friend. Costas' personal wealth before the sale of a half of his share was 20 ducats in hand 120, received from his parents, 100, invested in the venture, plus a 100% of the current net worth of the venture plus a 100% claim on the future profits of VC, in other words, 100% of the future net worth. His personal wealth after the private sale of a 50% interest in the venture is now 520 ducats in hand 120, received from his parents, 100, invested, 500, received from his partner, plus an only 50% interest in the future net worth of VC, which will include, as will be seen later, future profits of VC. Costas traded his rights to 100% of an uncertain reward, future profits or losses, for 500 ducats in hand plus only 50% of the uncertain future reward. He has diversified his risk, but reduced the possible high return, or loss, he would eventually claim from the venture when it is concluded. The wealth account of VC, integrating the fact Costas sold half his personal contingent claim on future profit is summarized in Table 1.4. As the reader can see, the sale of Costas' half interest in VC is completely external to the venture itself. It is a private matter between the two partners, both now shareholders. The only element recorded is that, if the venture were to be liquidated or earn profit, or loss, there are now two equal claimants on the net worth or profit, or loss, where there was only one before. Table 1.4 Wealth account of VC after step 3. Venture Costas owns venture Costas owes. Cash in hand 10 ducats owed to banker 900 ducats. Cash given to the captain for wages and operating expenses 150 ducats. Inventory of food and supplies 330 ducats. Inventory of merchandise to be traded 350 ducats. Ship and equipment 160 ducats. Total book value of resources, 1. 1,000 ducats total owed to third parties, 2. 900 ducats. Net worth of the venture, 1. 2. 100 ducats. Share of net worth held by Costas 50%. Share held by friend 50%. It can be noticed that, although the shareholders hold a claim on the 6 financial accounting and managerial accounting. As mentioned earlier, accounting is separated between financial, external reporting, and managerial, internal, components to reflect the distinction between the users, either mainly external or mainly internal. Managerial accounting deals with the informational needs of decision makers inside the firm. It therefore deals with complex issues such as detailed product cost, or business process cost analyses, or the diffusion of information inside the firm to create a mobilization of the energies of all members of personnel and staff. It spans a wide range of fields from cost issues to management of performance, including anticipatory management, motivation, and commitment building, and the analysis of deviations from plans. Financial accounting and managerial accounting use the same basic information, economic events occurring with the purpose of creating current or future economic benefits, for different purposes. They cannot describe events in different ways. Simply put, financial accounting tends to be a recording of historical events and reports it in aggregated ways, while managerial accounting uses the same information, kept at a higher level of details and structured differently, to forecast future situations through a fine modeling of business processes. In the end, both types of information processing should, and do, lead to the very same ex post measure of the amount of wealth created in a given period. Aside from being linked at the beginning, one single and unique basic record of the same event serves as input for both, and at the end, one single income statement. Financial and managerial accounting are also linked during the data analysis processes itself in that the costing aspect of managerial accounting, although used primarily for product and customer portfolio management, is also used, by financial accounting, for the valuation of inventories of finished or semi-finished goods, and of work in progress. Table 1.9 presents some key differences between financial accounting and managerial accounting. It is very important to remember that there is only one discipline called accounting. Although each approach deals with a specific angle of analysis, in the end both must be reconciled to give the same figure for the increase in the net worth, i.e., the amount of wealth created during a given period. 7 Qualitative characteristics of useful financial statements. According to the IASB, Conceptual Framework, IASB, 2010, QC1, the qualitative characteristics of useful financial information identify the types of information that are likely to be most useful to the existing and potential investors, lenders, and other creditors for making decisions about the reporting entity on the basis of information in its financial report, financial information. Figure 1.5 highlights the characteristics of useful financial information and the constraints it must satisfy. The two principal qualitative characteristics are relevance and full representation. The usefulness of financial information is enhanced if it is comparable, verifiable, timely, and understandable. 7.1 Relevance. 7.1.1 Definition. Relevant financial information is capable of making a difference in the decisions made by users. Conceptual Framework, IASB, 2010, QC6. Financial information is capable of making a difference in decisions if it has predictive value, confirmatory value, or both. Conceptual Framework, IASB, 2010, QC7. Managerial Accounting. Financial accounting Purpose: understand how value is created in detail so as to assist internal decisions, measure the performance of the firm as a whole and report it to relevant decision makers. Principal users of the output: managers and decision makers at all levels inside the firm and within responsibility delegation, senior management of the firm, but, originally, intended mainly for external users who look at the firm as a whole, investors, banks, customers, personnel, etc. Regulatory context: none in most industries. Government contract costing is regulated in most countries, but focus on continuous progress and a philosophy of balancing costs and benefits. Financial accounting information is a social good and is therefore regulated at least by the bodies regulating financial markets, by tax authorities and by the profession itself in a spirit of giving a true and fair view of the situation of the firm. Although the cost-benefit approach is not mentioned in regulations, it is common sense to expect that managers should never produce data or information at a cost that exceeds its expected benefits from better decision-making. Behavioral implications: aimed at mobilizing energies inside the firm by the distribution of the appropriate information after ad hoc analyses, does not attempt to influence behavior and, even on the contrary, tries to be as fair as possible to all parties involved. Time frame oriented toward anticipation, based on fine modeling of internal and market-linked business processes, and analysis of deviations between anticipated and observed results, and objective record of what was actually realized, thus mainly oriented towards the past. Comparison of periods allows extrapolation. Time horizon: flexible and continuous. Information is collected on any time period deemed interesting to the decision maker. Financial statements must be made available at predetermined fixed intervals. Orientation: detailed units of analysis such as business processes, functions, knowledge sets, customer markets, customer types, products, resources markets, etc. A process of systematic aggregation of records of discrete, simple, and elemental events to create categories of like transactions and create, in fine, financial statements that give a synthetic view of the situation of the firm on a given date. Fineness accent is placed on interactions and on the operation of business models, can be a finely partitioned as needed aggregate and ex post facto vision. Frontiers defined by the usefulness of the data, importance of commercial, strategic, behavioral, economic aspects and decision-making aspects. It is totally normal in managerial accounting to extend the analysis beyond the legal borders of the entity often defined and constrained by the regulatory and legal context. Financial accounting records transactions within the legal, or otherwise specified, perimeter of the entity and between the legal entity and third parties. Accounting information is useful both to account for what actions were taken and for anticipating what consequences these might create, including future actions that are linked to previous ones. It is, therefore, important to remember that the rules and principles which will be described below need to be subjected to the filter that, in the end, information is useful only if it helps understand the past, and particularly how agents have discharged their responsibility, and predict the future, by extrapolation or other more sophisticated models. 7.1.2 Link with materiality. The relevance of information is affected by its nature and materiality. Information is material if omitting it, or misstating it, could influence decisions that users make on the basis of financial information about a specific reporting entity. In other words, materiality is an entity-specific aspect of relevance, based on the nature or magnitude, or both, of the items to which the information relates in the context of an individual entity's financial report. Conceptual Framework, IASB, 2010, QC11. Consequently, the IASB has decided it cannot specify a uniform quantitative threshold for materiality or predetermine what could be material in a particular situation. Concretely, financial statements may contain approximations and minor errors not worth fixing in the spirit of a cost/benefit balance. It is of no consequence as long as their materiality places them under a threshold of significance, i.e., is not likely to affect the decisions of the users. With the speed of decision-making and the size of the stakes of the decisions in the new economy, an information ennobled-based economy has little hysteresis and a business turnaround can happen in no time. 18 issues of materiality have become extremely relevant and are often discussed in the press and more often, in court cases, weak signals can be leading indicators or forerunners of significant shifts in opportunities or problems. 7.2 Faithful representation. Financial reports represent economic phenomena in words and numbers. To be useful, financial information must not only represent relevant phenomena, but it must also faithfully represent the phenomena that it purports to represent. To be a perfectly faithful representation, a depiction would have three characteristics. It would be complete, neutral, and free from error. Conceptual Framework, IASB, 2010, QC12. A complete depiction includes all information necessary for a user to understand the phenomenon being depicted, including all necessary descriptions and explanations. Conceptual Framework, IASB, 2010, QC13. A neutral depiction is without bias in the selection or presentation of financial information. Conceptual Framework, IASB, 2010, QC14. Faithful representation does not mean accurate in all respects. Free from error means there are no errors or omissions in the description of the phenomenon, and the process used to produce the reported information has been selected and applied with no errors in the process. Conceptual Framework, IASB, 2010, QC15. P.23. 7.3 Comparability. Users must be able to compare the financial statements of an entity through time in order to identify trends in its financial position and performance. Hence, the measurement and display of the financial effect of like transactions and other events must be carried out in a consistent way throughout an entity and over time. Users also would like to be able to compare the financial statements of different entities in order to evaluate their relative financial position, performance, and changes in financial position. However, comparability is often in contradiction with the requirement of relevance. The need to choose a common coding process between firms for like events may lead to the choice of a lowest common denominator, i.e., a very coarse description of events or their consequences through which, in the end, very little is learned. For example, without reporting by segment of business, i.e., by types of markets or technology, in a complex firm, and most medium or larger sized firms are complex, total revenue measures may be misleading because revenues from a booming but narrow market may hide, temporarily, the declining revenues from one larger market that is dying. Total revenue is difficult to exploit and compare unless more than the bare minimum is reported. If left to their own devices, each management team would probably be inclined to code events in a way they feel gives the best description of the very strategic view they hold of their firm's business processes and results. The debate about the pros and cons of common coding of events and common presentation of accounts between firms is never closed. France, for one, right after World War II, opted for a common presentation and imposed a constraining chart of accounts, see Chapter 3, on all businesses. This is not the case in most of Europe, although Spain and Belgium also have a somewhat standardized chart of accounts, or in the rest of the world. Given that enterprises generally do not follow exactly the same format as other firms in the same sector, there is a need for an informational arbitraging business, provided, generally, as a sellable service by analysts, stockbrokers, banks, consulting firms or semi-governmental agencies that use sophisticated models and additional information to recast financial statements into industry-specific formats fitting the business model applicable to a particular industrial sector. P.24. 7.4 Verifiability. Verifiability helps assure users that information faithfully represents the economic phenomena it purports to represent. Verifiability means that different knowledgeable and independent observers could reach consensus, although not necessarily complete agreement, that a particular depiction is a faithful representation. Quantified information need not be a single point estimate to be verifiable. A range of possible amounts and the related probabilities can also be verified. Conceptual Framework, IASB, 2010, QC26. 7.5 Timeliness. If there is undue delay in the reporting of information, it may lose its relevance. Management may need to balance the relative merits of timely reporting, including the cost of the information technology and processes allowing such timely reporting, and of the provision of reliable information to decision makers. Balancing timeliness and relevance is a day-to-day issue for all businesses. Timely information is expensive, but missing a strategic opportunity may be even more expensive. The old issue is better approximate but timely information than untimely but very exact information. Which is best, a timely but approximate or not reliable piece of information or a reliable and precise but not timely piece of information? Each management team has its own set of ad hoc answers. 7.6 Understandability. The information provided in financial statements should be readily understandable by users. For this purpose, users are assumed to have a reasonable knowledge of generic business processes, as for example those shown in figures 1.1 to 1.3, and economic activities in accounting. They should also have a willingness to study the information with reasonable diligence, see Conceptual Framework, IASB, 2010, QC32. 8 Book value of shareholders' equity and market value of the shares. In the Costas example above we have introduced a key element of business when Costas, who needed to rebuild his private liquidity, sold to his friend part of his equity in VC for 500 ducats. The market value of equity, 500 ducats, is different from its book value, 50 ducats. As we saw earlier, accounting, A, is following the rule of prudence and records transactions at their historical value, and, B, only records transactions that have been concluded or have very high probability of being concluded. What Costas' friend paid for with his 500 ducats, privately transferred to Costas, the individual, was a 50% share of the future earnings of VC. That transaction introduced the market value of equity. When shares are traded on stock exchanges, always outside the control of the firm, their value is based on their representing claims on future earnings. We need therefore to revisit the notion of wealth and compare and contrast net worth, an accounting concept based on the current historical value of resources and obligations to third parties, and market value which reflects the value of the stream of potential future earnings the firm can create with the resources it controls, after paying to third parties for the cost of funding them. 8.1 Book value of shareholders' equity. When we discuss the net worth of a business, or the increase, decrease, in the net worth due to operations through profit, or loss, we are applying a fundamental rule of accounting, lower of cost or market. 19. As mentioned previously, accounting rules in practice attempt to serve the information needs of a diversity of stakeholders. They are therefore the result of compromises. Since the market value of resources can change over time due to a variety of reasons such as inflation, location, scarcity, etc., net worth, i.e., total value of resources controlled by the business at one point of time minus all debts to third parties, would change, if resources were shown on the books at their market value, fluctuating due to variables that have nothing to do with the effective management of these resources in delivering a value proposition to solvent customers. Accounting therefore adopted the rule of lower of cost or market for the valuation of assets, with often controversial exceptions for financial instruments, as we will see in Chapter 10. The nominal amount of debt, generally resulting from contractual agreements, does not change with time. By deduction the net worth at book value is the difference, at one point in time, between two quantities expressed on the same basis. Net worth is the result of the past and varies only due to the actions of the managers. P.25. 8.2 Market value of shareholders' equity. Shares represent the shareholders' investment in an incorporated business. If the firm is quoted on a stock exchange, the shares owners can trade them independently of the business management. Shares, therefore, have a market price. While net worth is the result of past data, the value of the shares is based on the expectation of return the current and potential investors see in the share. The value of a share is a function of the excess resources generated by the business over the resources it consumes, over its time horizon of viability, i.e., the horizon over which the business can legitimately be expected to remain a going concern. 20 Each investor, potential or current, estimates the future growth of that net excess of resources on the basis of their extrapolation of the past decisions of the management, including its investment, human resource, and development policies as described through the financial statements, and they're taking into account external and strategic parameters about markets, technology, and competition. The flow of net excess resources is then discounted 21 at a rate including the risk-free rate 22, the excess return 23 expected by investors in order to compensate for the risks of investing in the business, and expected inflation. The value of a share is therefore the net present value of the expected stream of earnings or cash, i.e., the present value of the streams of net resources received minus the resources consumed by the business over the time horizon selected. The value of a share is therefore based on estimated future parameters by each shareholder, or potential shareholder. Since no two investors ever agree exactly on the value the parameters, such as time horizon, evolution of the cost of raw materials or components, currency exposure, rate of growth of earnings, remuneration required for the risk level of the business or future inflation, there are always investors willing to sell if the price is right, overestimated according to their hypotheses, and others desirous to buy if the price is right, i.e., underestimated according to their estimates. The value of a share is therefore based on elements pertaining to the future, while net worth reflects elements of the past. 24 The market value of a firm, share value multiplied by number of shares, generally exceeds greatly the net worth shown on the books. For example, at the end of the first quarter of 2012 Apple Incorporated showed, in its balance sheet, a net worth of $90 billion for a market valuation of $590 billion or 6.5 times larger than net worth. The difference between the two metrics reflects both the undervaluation of resources listed in the books at lower of cost or market, especially the value of software developed in-house, but also the value of land or buildings, or the value of the brand name and its distribution system, and the aggregate estimate the financial markets place on the future growth of Apple and its level of risk. 8.3 The role of accounting in managing value. Financial accounting does not only describe the past transactions and results of a business. It also provides an archive of data the investors can use to make evaluations about the future. To do so, the investors merge accounting data and information about the past, with contextual information about markets and competition in order to estimate the four key parameters of the value of a firm. A. Future growth of earnings or cash flows. B. Time horizon of viability. C. Excess return required over and above the risk-free rate, and D. Evolution of the level of risk due to the firm's own actions, such as investments in R&D or commercial strategic activities. The value of an accounting report is equally based on its ability to assist the decision-makers in deciding on these four parameters, as it is on its reporting a measurement of the growth of net worth over the period. 9. History of accounting from Sumer to Lucapecioli. Accounting is not the new kid on the block. Some historians, Colas and Lesage, 2010, 26, assert that marks found on bones dating as far back as 20,000 or 30,000 years ago were a form of accounting, recording claims of various tribe members on the result of hunting expeditions. Let us see how modern accounting originated from before the time of the Hammurabi Code in the times of ancient Sumer. Hammurabi 25 ruled Babylon from 1795 to 1750 BCE, 26 to the founding work of Fra Luca Pacioli, 1494, that recorded the accounting practices of Venetian merchants, based on the earlier practices of Florentine bankers, themselves adapted from those of earlier Arab merchants, and allowed the development of modern accounting. 27. 9.1 Sumerian times. The origins of accounting are often traced to the times of Sumer, in Mesopotamia, starting in the 4th millennium BCE. The Sumerian civilization predates that of ancient Egypt by a few centuries. Archaeological explorations in the region between the Tigris and Euphrates rivers have unearthed innumerable vestiges of accounting documents recorded on stone or clay tablets. The very fragility of the material was the guarantee of the security of the record, because any attempt at falsification would have caused its destruction. The efforts to protect these tablets were commensurate with the likely desire to uphold the contracted commitment and the corresponding counting. As far back as the 3rd millennium BCE, during the Ur dynasty, accounting entries became both more complex and precise. All features of a modern account were recorded on clay tablets, nature of objects being transacted, names of the parties to the contract, quantities of goods and their equivalent value in other goods or currency. Some tablets even carry over the balance of the previous period, separate increases from decreases, and also show the end of period balance. In some cases, rules were discovered that required use of materials such as stone, more sturdy than clay, to record official or sacred accounts or statements. One such example is the Hammurabi Code, which dates back to the 18th century BCE. This document reflects societal rules in Babylon. This text, essentially about contracts and family law, contains notions of accounting and management that refer to an agency contract. This implies that the agent keeps clear accounts, or, more likely, that some specified transactions be recorded in the form of accounts, bookkeeping. Accounting, then and since, has always been placed in an agency context. The issues are, A. To define the increase in wealth, profit, resulting from transactions carried by the agent, manager, in the name of the principal, owner. B. Provide the basis for sharing wealth created between the principal, the agents, and other stakeholders, and C. Keep a record of who owns or has control over what, and who owes what to whom. Surprisingly, this first accounting civilization seems to have left little further traces when the cuneiform language 28 it used was supplanted by the more efficient Aramaic and Phoenician languages and writing techniques. Is this due to an unlikely abandonment of the principles of accounting, or more likely to a change in physical support or to wars, which left no archaeological archives, is an intriguing question that remains open today. 9.2 Accounting in Egypt. Accounting was well developed in ancient Egypt. Scribes had a simplified script, less complex than hieroglyphics, dedicated to home and business economics. They were required to know both arithmetic and bookkeeping. They kept their records on papyrus, a lighter and more flexible but more vulnerable medium than stone or clay tablets. Transactions were registered first in draft form before being copied carefully in definitive chronological records. From time to time, and at least once a year, chronological records were summarized in synthetic documents. Accounts had all the characteristics of universal accounts: name of the account, date, and amount of the transaction. Receipts were distinguished from disbursements. From 300 BCE, Egyptians, who by then had become a part of the Greek cultural universe, adopted the Greek language and practices in banking. These include account-to-account transfers, which are an essential step in the development of modern accounting as it provides a way to add to or subtract from any account without actually going through a cash transaction. p.26. 9.3 Accounting in Greece. Greek accounting was, as already mentioned, very advanced. Some historians believe that temples were the first organizations to need accounting, and incidentally to play the role of bankers. Exactly as was the case in ancient Babylon, in Hammurabi's code, temples explicitly have a role as bank of seeds, or in Egypt, offerings to the gods were recorded on marble or limestone tablets. Independently of temple accounting, Greek bankers kept thorough accounts. The complexity of the banking network led to the development of accounting control systems, the predecessors of auditing. As far back as 300 BCE, Athens had an audit court comprised of 10 logists, 29 who had the responsibility of controlling accounts. The set of practices, including completeness of records, thorough controls, and existence of public records, and accountability, obvious signs of democracy, seems to have vanished with its demise. 9.4 Accounting in Rome. In Rome, each family, a much broader concept than the nuclear family of the 21st century CE, a family included all parents from all generations plus uncles, aunts, and their offspring as well as a multitude of servants and slaves, was in fact an economic entity with its own production and trading systems. The concept has endured in the Italian accounting and management tradition called economia aziendale. 30. Keeping books was the responsibility of the head of the household, pater familias, as it is the responsibility today of a person heading an enterprise. According to Cicero, 143-106 BCE, who described the set of books kept in his time, the main document was the Codex Accepti et Expansi or Journal of Receipts and Payments. Entries were first recorded in a draft before being organized in the Codex. The Codex Rationum was the permanent document with value of proof. It was the predecessor of what we now call the General Ledger, see Chapter 3. The demise of the Roman civilization caused the disappearance of this body of accounting knowledge. 9.5 Accounting in the Middle Ages. Although the so-called barbarians overran and destroyed the western part of the Roman Empire early on, the eastern part of the empire, including Greece, Constantinople, and the Middle East remained untouched for a while. The Greek accounting expertise was preserved in the Byzantine Empire. The development of the Arab civilization and its intense trading activity capitalized on the accounting knowledge of the territories it conquered and developed it even further by incorporating refinements derived from mathematics and astronomy. It is not clear whether the Western European merchants learned from their Byzantine and Arab partners or whether they actually rediscovered administrative and accounting practices. The fact is accounting underwent a rebirth in Western Europe, mainly in northern Italy, the Netherlands, and Flanders as early as the 13th century. Whether merchants formed large, multi-establishment companies, the predecessors of our multinational corporations, or dealt through mercantile or commissioned agents, they needed rigorous accounting. Accounting recorded transactions, wealth created and its transfer between establishments. This allowed agents to be, or made them be, accountable for their activity. The development of international trade, of capitalistic companies, deliberate separation between the providers of capital and the actual decision-making with the intent of growing wealth, and of agency contracts is probably the major cause of the slow re-emergence of accounting in the Middle Ages. The extended period of resurgence has known three sequential phases: memorial, single entry, and double entry bookkeeping. 9.5.1 Memorial. The memorial is essentially a journal recording a business entity's transactions on a daily basis without any attempt at regrouping transactions of similar nature. It is essentially the same rudimentary practice that was predominant in early antiquity. 9.5.2 Single entry bookkeeping. Single entry bookkeeping is a significant improvement to the simplistic memorial method. The growing complexity of the operations of medieval merchants led to the partitioning of the memorial into separate accounts of similar nature, such as purchases, payment to labor, sales to a given customer, etc. Each type of transaction within or between establishments or with third parties is recorded in its own coherent specialized table keeping track of all relevant specific events, thus forming an account. 9.5.3 Double entry bookkeeping. Double entry bookkeeping marks the birth of modern accounting. Each transaction is recorded by entries in two accounts, one entry credits 31 one account and the other one debits 32 another one. The earliest record of double entry bookkeeping is found in the books of the Massari, treasurers of the city-state of Genoa, around 1340 CE. However, it is the Franciscan monk, Luca Pacioli, who formalized and extensively described these procedures in his 1494 mathematics text entitled Summata Arithmetica, Geometria, Proportiona et Proportionalita. Incidentally, his purpose in inserting a chapter on accounting in his book was not to write a business text, but to illustrate one way of handling the concept of zero which had been lost to Western European mathematicians, although not to Arabic ones, but the Western European merchants and the Arabic ones were not exactly on friendly terms at the time. In effect, the fundamental equation of accounting debits 1/4 credits or resources held 1/4 financing, i.e., obligations to outside parties shareholders' claims, shows that, if this is true, the balance has to be zero, i.e., nothing, a very difficult concept to apprehend at the time. It was especially important for accountants to be able to show, for example, a debt had been paid back, or extinguished, and that the borrower, in fact, owed nothing, but the record of both the debt and its payment should not have been lost in the recording of the settlement. This was done easily, for example in the books of the borrower, by simultaneously reducing cash, a resource, and reducing the debt account where the borrower's debt was recorded, thus, eliminating the debt. In Chapter 3, we will see that accountants use specialized words, credit and debit, to describe the increase or decrease of a resource account, or the opposite direction for an account representing an obligation to pay a third party or shareholders. Modern accounting was born with Luca Pacioli's work and its broad diffusion. This text will deal only with double entry bookkeeping and with the accounting that derives from such practice. We will however use the terms debit and credit as little as possible since this text is written mainly for students of management and not for accountants.